Okay, welcome back to our lesson on trading using the entry rules for participants at the Fast Trade Fair. Now, because the Fast Trade Fair is an event for people who are business owners in other fields, we trade the financial market over the counter in the Fast Trade Fair, relying on the support of our broker who represents the wholesaler, just like those who are retailers in their various businesses know that for them to make profit, they have to deal directly with the wholesaler if they cannot deal with the manufacturer. In the same way, in the market, if you cannot deal directly with the swap providers, that's if you cannot trade swap directly, then you will have to deal with the wholesaler, and that is the broker. Okay, so for the broker who provides you access to all the instruments or assets to be traded, just like your wholesaler provides you with all the products you want to stock in your retail store, we already have a specific asset that is of interest to us right now on the screen. And we want to explain how to base your entry on rules that are easy to follow. Of course, when the conditions are met. But note that there are no perfect situations in the market when the rules will always be clearly followed 100%. So there will always be some these there will be some obliterations. Yes, that's the best word to use, which means that you won't see clearly what the market intends to do, and your rules at that point might suffer some sort of doubt and disbelief from you. So, but when you have those situations present themselves, how do you respond? Because the market is a real time activity. Just on a trade fair, you are right there in the market with your goods, waiting for customers to come and accept your price and buy as much as they can. You, in this case, are dealing directly with the broker who is representing all customers for all products you have. So the broker will always accept whatever you present, just the same way you accept the broker's own quote. So if you come with any quote, the broker will accept it and get you a contract. And that is what you pay attention to. Why should you make a quote for the broker? And then what are you looking for before you accept a quote asked by the broker? So let's look at that. Okay, so looking at the chart here, we are starting from the previous week. The crosshair here, this whole session here was Friday of last week. Now, before Friday, where you could see a clear move to the upside, there was first delay happening on Friday, the early hours of Friday. There was delay up until afternoon of Friday, that was about 11 a.m. and 12 noon. So up until 1 p.m., there was still this uncertain move in the market. But in all these moves, you could observe something happening, which is why we use the arrow line to indicate what was happening and what you could have been doing, because you cannot stay idle. We are assuming that any of this week could represent the week you were present at the financial market trade fair with your capital at the fast trade fair. And does it mean that for a week where the market is not moving in a particular direction, clearly you will not make any money and you will go home disappointed? No, there are small moves that the market will make that you will need to understand how to take advantage of them while waiting for the big move. But first, you would be able to anticipate where the big move should go to so that you can ride the wave of the big move. So that is what we saw here. This arrow line shows all the places you took action. So on each day, there are several course of actions that you could have taken, which is what the arrows here are representing. But what we want to take note of is that there was no clear direction from Monday, Tuesday, Wednesday, Thursday, and Friday. Friday was when we saw the big move, right? Okay, so one day out of 5 days of the week. But in all of that, there were small, small moves that gave you entries that you would have benefited from, all the same. So, how do you find your move? And what do you look out for you to take advantage of the move you are currently seeing? Now that brings us to this week. Now we look at this big move that happened there. It is clear, so we can use it as a starting point. Now the market made a move by, we call it impulse, when you see a string of same colors, a string of same colors above 3. That indicates an impulse. When it is 2, it is called fragmentation or fragmented move. So impulse, 3 or more same colors. You can see them on your chart here. So this was clearly an impulse and it was made up of more than 3. Then your entry is, this is how we define the entry. If there was a previous string, or pattern as we call it also, which is the same color that met the criteria of impulse, that's 3 or more. So you can see that there was a previous string here. The rule says when broken or terminated, that is called impulse termination, which means when another color comes to end the string, that color gives you what is called your exit price. So you can always draw an exit price using a horizontal line to draw an exit price. So in this case, the exit price was 1.22131. We are drawing it from this bullish candle's closing price that terminated the short bearish impulse here. So now your entry begins from the first candle that opens in the direction of the candle that ended the previous impulse. So that is your entry bias. So if the candle has a bullish bias, which means the price went up to end the movement on the downside that was on an impulse, your entry will be for a buy, which means that you are going to buy the asset at the new price of the candle that opens after that candle that terminated the impulse closes. So this was a candle that terminated the impulse to the downside. Now this was a candle that opened after its closing. So this could be your first candle. This is where the second candle principle comes in. So second candle principle, we have third candle principle, and we have fourth candle principle. So first of all, second candle principle, we can summarize it as when the impulse was broken by a candle that did what we call overshadow. So it overshadowed 2 or more of the previous impulse candles. Then you can enter on the second candle when the termination candle or exit candle closes. So this was the exit candle. It met the criteria for 2 entering on the second candle because it overshadowed not just 2 but 3 candles, right? So it overshadowed the full previous bearish impulse, and that gave us our next candle that opened after it. You take a buy, because buying means we are entering in the direction of this candle. The price was going up, so we want to go up with it. And then you will now, having taken your entry, exit when the next impulse forms and is terminated. Your exit price is the termination of the next impulse that forms. So if that is understood, that is why the arrow you can see here started from the second candle and ended at when a new candle came that terminated the impulse, right? Okay, so that condition met for entering on the second candle. We have entering on the third candle and we have entering on the fourth candle. So let's look at this new week. What happened? We were supposed to have an entry somewhere around there. Now there are cycles, market cycles that you need to track. The cycles start from consolidation. After consolidation, the cycle goes to accumulation. After accumulation, the cycle goes to distribution. So those three cycles, you will need to understand them, just like there are phases also. After consolidation, the market goes into a phase called an expansion phase. And after expansion, the market goes into a trend phase. Then while the market is trending, the market would give us what is called an impulse move. Then the impulse move, once completed, would need a correction move, which will go in the opposite direction of the impulse move. So when you see an impulse move, it indicates that the next move will be a correction move. But the market may not immediately correct. And that is where you have what is called distribution occurring. So what happened here will be called distribution. Now, because correction will come downward, the market will need to distribute to gain liquidity that it will use to come down. Okay, so now that was what happened here. This was a distribution. Players were entering the market to push price to the upside so that the market can start distributing from the up price or upside down to the downside. So at the point of market exhaustion, you now see your entry. So what happens is you first of all, to know your entry point, allow the market to form the distribution block, which is what we see here. This red box here is the distribution block. Now, your exit price for the termination of your previous impulse move, you have to mark it with a horizontal or a slab. So mark it with a slab. And that is what you do. You mark it at the, if it was a bearish, if it is a bearish termination, which means a bearish candle terminates a bullish impulse, you will have your slab at the high of the bearish candle or the termination or exit candle, as the case may be. If it was a bearish impulse and a bullish candle terminates the bearish impulse, just as you can see here, bullish candle terminates the bearish impulse, you will have your slab below the exit or the low, below the low of the exit or termination candle. So that is what you have here. And what usually happens is that slab is not there for nothing. It serves as a watch price where you expect that when the market gets to that point, which is where your stop loss will be, 10 pips from that slab is your stop loss. When the market gets to that slab, after, of course, moving away from it, it's going to be the end of that market move and it will change direction. So in a case like this is where the slab is. So you expect that when the market gets to this slab, it will change direction. Now, you expected, because there was an impulse, you expected a distribution, which means that the market will, first of all, show you an attempt to violate the stop loss, because you cannot be entering immediately. You would have entered immediately, like sometimes it comes that way that you have to enter immediately a sell. Okay, so let's take it that we are going to enter on a sell. On which candle will you enter on a sell? We have the first candle that broke the impulse, the second candle that continued on the impulse, right? Okay, So you could have entered on the sell because this candle did not meet the second candle entry criteria. It did not engulf two or more candles of the impulse. So this termination candle did not engulf two or more candles. It means that you will not be entering on the second candle, rather you'll be entering on the third candle. Okay, so now entering on the third candle gives us a green candle here. Okay, now we say that the entry candles always or most often goes against your entry bias. Almost and always, if not always, it almost often goes against your entry bias. So each time we point at an entry candle, you will see that it went against your entry bias. If you were buying, it will sell. If you were selling, it will buy. We'll observe that as we go forward. But in this current situation, the candle was supposed to be for us to sell, and the market bought. So when it bought, it created this distribution box. But we assume that you enter there and you place your stop loss above this box so that you don't miss out on the chance of taking profit, right? While you still anticipate your entry to the downside, because this impulse here has not been corrected. Every impulse must be corrected. So that's the rule you are paying attention to. So you took an entry here and your stop loss was 10 pips above this box, right? So let's look at the box here. 1.2388. It means that you have your entry at 1.2398, which is your stop loss will be 1.2398, and you can see that the market went to hit your stop loss. Now you are out of the market. Now what was the loss? 1.23722 to 1.2398. So that was about 25 pips. That was about 27 pips loss on that. But remember that the move you are targeting here is a huge move. So now the market hit your stop loss on this candle because all of this distribution which you did not preempt, because if you had preempted it, you will wait for the distribution to form. But because of the market always doesn't have to do this, you took your entry, okay? So taking your entry, the market hits your stop loss, and now you are looking for your next entry. The condition for entry is not met anywhere else here, because if you were on this entry here, you are not going to exit. No bearish, yes, you see, no bearish impulse that was broken for you to have exited. So you are not exiting until the market hit your stop loss. That's important to note for consistency. Then after hitting your stop loss, the market made another move. There was nothing to watch for as new entry. Okay, it was not a bullish impulse that broke. Okay, so you are not entering anywhere around here. Then the market reached the zenith of its what we call distribution, and here the sell pressure came in. Look at what happened here when the sell pressure came in. It engulfed the two or three previous candles. So let's say it engulfed these two bullish candles, right? And what does that tell you? That when you see such an engulfing candle, you are going to enter on the second candle, or the candle that opens immediately after it, entering in the bias of what? Entering in the bias of the candle that broke that string. But in this case, there was no impulse string, but it was an engulfing candle that engulfed two candles. So you enter on this candle. So this would have been your entry candle in this case, and you are entering the bias. Since it was a sell, you are going to sell. Now, if you entered on this sell, remember that you are entering on this sell, not waiting for this your stop loss that was broken before. Okay, you have entered on this sell. You're only going to exit when an impulse forms and is terminated, and that is what happened here. You entered on this sell. The market, of course, your stop loss will now be on the engulfing candle high. So above the high of the engulfing candle will be your stop loss. That could be a wide one if you have the capital to bear, but that is your ideal stop loss. So 10 pips above the high. So that was 1.2427. That would be 1.2527, right? That would be your stop loss. So the market didn't go anywhere again near that stop loss, but rather moved downward, created that impulse you were looking for, and terminated the new impulse at 1.2343. So how many pips of profit was that? 2343 all the way from 2391. So that is around 40 pips, right? 40 pips. Now you see, you have paid for the stop loss that was taken and made up to 20 pips profit at this point. Now, what do you expect? You know that we were expecting a correction that would happen to alter all the moves of the impulse here. So the correction must alter all the moves of the impulse here, because before the impulse there was a trend start point. So the move of the impulse here, if it is altered completely, will be up to 50% of the total move in the trend. So however big that move was. So if you had entered here following the rule for correction, you would exit here and look for your next entry. Okay, so if you exited here, your next entry will be when a bullish impulse forms, is terminated, and you enter on the second candle if there was an engulfing candle before that, or the third candle if there was no engulfing candle before that. So in this case, there was your termination, which was your exit for 40 pips profit. Then this was the end of Monday. Tuesday began. Because your exit was at the end of Monday, it means that you are expecting a consolidation. So you could have been expecting a consolidation and you want to draw your consolidation box and all of that. So if we go to the lower time frame, you could have seen a consolidation around here that would have based your entry on. All right, but let's stick to the 1 hour time frame to do this explanation. Okay, so now for your next entry, what are you waiting for or looking for? You are looking for the possibility of a bullish entry, which would have been the case if this was not an impulse that has not been totally it has not been totally covered by correction. So a correction is still ongoing. So you are only expecting that, yes, you exit here, allow the market to do its consolidation, where new market players will come in, then you enter again and come down. Okay. So now found we found a what did we find here? A string forming. That's another way to enter on an impulse, a string forming. So that is when you enter on the third candle. Now, because there was no bullish string that terminated, instead a bearish string was forming, we'll have the first candle, the second candle, then the third candle after two bearish candles. That gives you another bearish entry. That's the third candle. So same way, if you have seen this formation here, first candle, second candle, you could have entered on the third candle if there was no impulse that was terminated here. Okay, so that is what we saw here. Now there was no impulse, bullish impulse that was terminated here for us to look at the second candle entry if there was an engulfing, and where there is no engulfing third candle. So here no impulse was terminated, but a new impulse is forming because this is a string of bearish candles, 1, 2, and 3. So you enter on the opening price of this candle and wait for the next impulse to exit. So when you look at your entry here, this, of course, where is your stop loss? Your stop loss will be at the high of the candle that started the impulse. That is always the case. Okay. If that is an impulse start, okay, or a previous impulse break or termination. So either of them, the same thing. So the first candle that started the impulse or the candle that terminated the previous impulse, both of them are the same thing. So entry here, then you hold until a new impulse forms that is terminated, or you wait until your SL hits in the same way. So here, your SL would have been at from 1.2346 to 1.2356. That's 10 pips above that high, 1.2356. And notice that the market did not come around there. So, but it moved down. No impulse formed while you are still holding your sell. Then finally, a bearish impulse formed here. And this was a bullish candle that came and did what? Terminated the impulse. So you exit on the closing of that bullish candle that terminated the bearish impulse. So how much profit did you make? 1.2294 all the way from 1.2337. So 1.2294, as over 40 pips. You can see again, over 40 pips, 2297 to 233. Okay, so that is over 40 pips. In this case, since there was no previous loss, you are only adding up your profit to the previous profit. So you had got a balance of 220 pips profit, now plus 40 pips here. That is about 60 pips profit already for the two entries. Now, this takes us to, this is Tuesday. This takes us to the next situation you're looking for again, another forming impulse, right? Another forming impulse if no bullish impulse forms. Okay, now let's look at it this way. Correction is still ongoing, which means that you expect to go on a bearish entry, not on a bullish entry, of course, because you have not got a total recovery on this move here on the previous impulse. It needs to totally cover all of the pips covered by this impulse. So this is the end of 218 is what you are looking at, the end of correction. Okay, there must be a complete overshadowing of the previous impulse. That is what happens. So in this case now, let's look at it, because that will be, let's explain it, that will be full 100% or 50% rather of the total bullish or trend move. So a correction is happening for trend, like a retracement on a trend. So now this is it. After an impulse here was terminated, you expect that if you wanted to follow the entry rule for impulse, normal impulse termination, entry on the second candle, you see, you cannot have entered on the second candle because the candle that terminated this impulse did not overshadow two candle, which you call engulfing, did not give us an engulfing candle. So second candle entry wouldn't have been the case. Now third candle entry would have been the case in this case, which means that you would have bought here ordinarily if you were not trading a full surface correction or retracement. So in this case, you are not entering here. You are waiting for a formation of what? Another impulse to the downside. That's what you are waiting for. Formation of another impulse to the downside. Now, this is what happened. We have one bearish, two bearish candle. A string was forming. Then the third candle. I haven't seen this two just like you did before. This would have been what? Your entry on a sell. Okay, your entry on a sell. And like we say, entry candles always do what? Or often goes against the bias of your entry, right? Intended bias. But let's look at it. Your stop loss would have been where? 10 pips above the high of the candle that gave you that start of an impulse, okay, or a string as the case may be. So let's look at it. Your stop loss will be 10 pips above 1.2310, which will be 1.2320. And this entry didn't go all the way to that stop loss. Instead, what happened? It returned down afterwards. So all of here, you are on negative, but it did not go to your stop loss. Stop loss is still in a protected zone. You are on negative until the market returns back to your entry price. Okay, so you are not worried about all these new impulses that formed here because you're already on the entry here. So the market comes down to your entry price and goes into profit, got terminated at this point. So let's calculate how much profit that was. 1.2254, 1.2254, okay, all the way from 1.227. So that was about 10 pips. That was about 10 pips added. So 60 plus 10, that's 70 pips total, right? Now, at this case, the market has done what it needs to do, but it's still not done the full correction. It's still not done the full correction. You have traded 2 days of correction. That is slow. Now, this is the third day. Okay, so this is Wednesday of the new week, Wednesday. And now on Wednesday, what are you looking for again? You are looking for, this was a turning point. Don't forget, this was a turning point. This was a turning point, and you expect that the continuation will be when the market comes back down. All right. So let's look at it. If we are trading the normal impulse break again, remember the rules. You have to understand the rules and remember the rules. So now there was an impulse here. that you are already on an entry that did not hit your stop loss, and when the impulse formed, okay, you are expecting what? Second candle, the rule of second candle entry is that the candle that terminated the impulse should engulf two or more candles. Now, this candle did not do what? Engulf two or more candles of the impulse. And what happened? This was what happened. You could not have entered on the second candle if you were trading normal, okay? You would have entered on the third candle. And like we said, all entry candles go against the bias of entry. Now, you're supposed to buy on this candle if you are trading normal impulse break. What happened? Because this was supposed to be a buy entry candle, you see the candle did what? Closed bearish. That is always the case. So you can always know all the entry candles by just looking at where the impulse broke. If there was either an engulfing candle for it to have second candle entry, where there was no engulfing candle, you have third candle entries. Almost all the third candle entry points will give you that formation. And that is why we have many of such strings forming. We have many of such strings that form two strings formation that fails to give you an impulse. Now you notice that happens everywhere. You can simply draw a summary on that. That what forms the two string fragmented, okay, fragmented move is entry candles. Entry candles form the two string fragmented move. So that is why you have more two string fragmented move than you have impulse move, because that happens every time you're supposed to enter for an impulse to continue. It now becomes a termination of a two string fragmented move. So now this is it. Now, in this case, what are you looking for? You are still looking for a bearish entry, don't forget. You are still looking for a sell. Okay, now the condition for it to sell is that you will see a formation of what? A two string, so that you enter on the third candle. Unless there was an engulfing candle, just like we saw here. Unless there was an engulfing candle, like here. So this bearish candle engulfed two of these two string fragmented move candles. So same here. Was there an engulfing candle? No. So this supposed entry candle for a buy closed bearish but did not engulf these two candles. If it had engulfed these two candles, you have entered on the second candle as a sell. So you didn't take a sell, neither did you take a buy or immediately, okay? Because we are looking from the left to the right. Some other person will take a buy here because this is going to give you based on just normal impulse and entry. And this would have been also on the fourth candle entry rule. And the fourth candle entry rule, let's stay that fast. The fourth candle entry rule is when you know that the third candle entry always goes against the bias of your entry, okay, you just decide to delay the entry on the third candle and wait to enter on the fourth candle. That's on presumption, okay? And that presumption is that if you had entered in the market, you would have been holding your position on negative for the entry to close against bias candle. So that is why, based on presumption that should have been your entry candle that you delayed, the fourth candle can just be an earlier entry price starting from where the third candle closed. So that is what gives us the fourth candle entry. And in this case, this should have been a fourth candle entry. But don't forget that we are trading an overall move, which is a correction move that's supposed to cancel out the total move on impulse. And if you look at where that is occurring, we still have a lot of move down to the end of correction. So the correction has not ended there, which is why we are looking for a bearish entry. Okay, so we are looking for a bearish entry, and that's about 20, almost 60 pips down. So let's find the next entry point. So looking here, this is for those who traded normal impulse entry, okay, based on fourth candle entry you bought, but we are not buying because we are using our rule to follow the correction. So for the whole of Wednesday, you didn't get that requirement for entering a bearish entry again. The market has gone back into this box here. Of course, that stop loss, remember that stop loss here has not really been discontinued, okay, or struck out. So the entry on here that the entry you took here, that the stop loss was set at the high of this candle, 10 pips above the high, that entry would have still been secure if you are there. But all the same. We are waiting for a new bearish entry, right? And what's the rule for bearish entry? Let's look at it. Rule for bearish entry again, in this case, since we're looking for bearish entries, let's see a string that is almost to be an impulse. It might end up being a fragmented string, okay? Then we'll take an entry. So let's look at this. In fact, that could be explained properly here for the fourth candle entry rule, okay? Now this is it. You already know that entry candles always give you what? Go against the bias of your entry. Now this was supposed to be a buy entry, it's not a sell entry, right? But the market moved up, okay? And now for those taking the fourth candle entry rule, as the market goes up, it engulfed first candle, but did not engulf the second candle, right? So this would have been your entry based on fourth candle entry rule. Sell, and that would have been so beautiful. You still have your stop loss at the same place, but you have more profit to have gathered from there. So let's look at it if you had entered from there on fourth candle entry rule, which is why most people take the fourth candle entry. Okay, 1.2297 all the way down to 1.225. That would have been more than 10 pips. That would have been almost 40 pips. I mean, more than 40 pips added. So you see, so fourth candle entry rule sometimes is very favorable and can be two-way, or what do you call it, a double-edged sword. It can pierce you to a loss, but minimal loss compared to, you know, so the risk is still minimal compared to the reward. So let's look at it. Always know where your stop loss will be and do that correctly. So now we say we are looking for a sell. So which means that for us trading the correction, this will not be our concern, this bullish move. People who are not trading the correction, who don't know our rule, would have traded this on an impulse basis, okay? Based on fourth candle, they would have bought here and held all the way here and made their profit fine and good at this point of termination. That would have been fine and good. But we are trading correction, so we are still believing that the market needs to go and complete the bearish move. That is what this our down arrow is representing. This down arrow line, we drew it from the first day. We drew it all the way from here and it's pointing downward, you can see. So we have not reached the end of that line. So we are still trading the market, looking for the end of that line when we'll exit our correction move and start trading normal. So right now we are looking for a bearish entry. This is Wednesday already completed and now we are in Thursday. So let's look for where we would have seen a bearish entry. Remember, the bearish entry will be break of a bullish impulse. Okay, that's the first condition. Break of a bullish impulse, then we'll enter on what? If we are entering on the second candle, it means that the termination candle would have engulfed two candles, right? So now, this was a termination candle for this bullish impulse. What happened? It did not engulf, so we could not have entered on the second candle. All right, now the entry would be on the third candle. So what happened here? Based on this previous impulse, for those who traded this impulse, right, for us who are selling, this would have been our sell, then our stop loss would have been here, okay? So let's look at it. So we are taking our entry on the third candle because there was an impulse, okay? But now, when there is an impulse like this, we usually use the breaking of the closing price of the candle or termination candle, the candle that terminates that impulse. So we would not have entered even on this third candle. We would not have entered on this third candle. Reason is it opened above because this second candle did not form a string with the first candle that terminated the previous impulse, right? So we would not have entered on this opening price of the candle. So yeah, it looks good, like we would have just entered, but no, our rule says that we have to wait for this exit line to be broken. And we enter on the next candle that opens after the breaking of that impulse, okay? So of that exit line. So this, which would have been the best entry, is not our entry based on the rule, okay? Then this would have been our entry candle. This, you see this green candle here would have been our entry candle. That's following the rule, okay? Now remember that we say entry candles always go where? Against the bias of entry. So you see this candle was supposed to be for us to sell because the exit line was broken for the first time, and this was supposed to be an entry to sell. But what happened? It closed up. So for those who are trading on the fourth candle rule, this is where their fourth candle principle comes in. This is supposed entry candle, okay? Following that, they expected this to happen, they take their entry on the sell here. Fourth candle again would serve as a decent one. Okay, so but for us, this is the ending of Wednesday, and we know that the next day opens with sort of restructuring of the market. Even though we still have the overall move, there is supposed to be a consolidation, then forms a new block and all of that. Okay, so let's look at this. Entering here would have been a best entry for us, holding on the previous, the previous day's moves, calculating all of this put together based on this exit price line that we say is very important for the market and could also serve as a new turning point for the market. So we have two things to check out here. Whether we entered, in fact, we have three things. First was whether we entered here a sell, our stop loss would have been here, and we exit only when we see an impulse that is terminated. Is that not so? So now looking at this market move, if we had entered here, based on what we have explained, if we had entered there, that's the third candle entry rule, of course. If we had entered here, of course, the market moved all the way so well into profit, then did not give us any impulse that got terminated. No impulse was terminated. So which means I would have still been in the market. But what happened? From here, the market, before it came down all this way, if you are in this market, you will not be worried about what's happening here. All of this move for the new day would not have been worried you. But the market would have come, then stop loss would have been struck out. This was supposed to be 229 to 2308. 2308, right? 230. Oh, the stop loss is still safe. The stop loss is still safe. So 2298 to 2308. That's the stop loss. 2308. Stop loss is still safe. Good one. So all these moves have not struck out your stop loss. That's if you had entered on the third candle here based on the rule of this impulse. But remember we said something. The stop loss, of course, is the same no matter where we enter here, no matter first candle, second candle, third candle, because what defines our stop loss is the termination of the previous impulse candle. Okay, so the stop loss is always the same, just that the risk will be higher in case the stop loss is struck out. So any of the rules you follow can limit your amount of loss as the case may be. But in this case, stop loss was not struck out again. First case for the sellers, just like in this case, stop loss was not struck out here. Okay, so 2 times stop loss was not struck out. Then the sell continues. So for any of the entry that we are taking here, first entry here, stop loss still protected. Second entry here, for those who are taking the third entry rule, second entry would have been, this is the entry candle, stop loss still would not have been struck out. Then third entry here, for those who are following the fourth entry rule, fourth entry here, stop loss is still well intact, but it was almost at risk for those who would have been afraid to close. That's why we say respect the exit plan, just as you follow the entry rule. Respect the exit plan. So you see that because of respect for the exit plan, even when the market seemed to be going against you, you held it, the market returned back all the way and put you in profit. But now what is happening? What is happening? Where should you exit? This is the plan again. If we say we are waiting for what? We are waiting for what are we waiting for? We are waiting for your exit on profit when an impulse forms in the bias of your entry and is terminated. So if this was a 3 candle bearish impulse, you would have visited this market on this candle. This was just a fragmented move, okay? So this is not your correct exit price, not at all. So in other words, you are still in the market for the sell you took on either 1, 2, or 3 candles. You are still in the market. All right. So being that you are still in the market, you are holding a sell. This whole move here isn't supposed to bother you, right? Because you are not out on profit. But is there any other time you should have taken your exit out of fear or out of the possibility that the market is going to change bias? Let's look at it. That will be stating another rule, when a new impulse forms, opposite the bias of your entry. So what do you do? An impulse forms, this is it. When this impulse is a string formed by three or more candles, right? So if this third candle closes bullish, then you are definitely going to have to exit on the fourth candle. Why? Because this is an impulse. This is what? An impulse. So you would have still been holding this position, right? But another place also you could have entered is before the impulse. First candle, opposite your bias. Third, second candle opposite your entry bias, then you know that an impulse is likely to form. So for most people who are doing the reverse order, instead of waiting for it, just like those who are doing the fourth entry candle, instead of entering on the third candle that always goes opposite the bias of your entry, they enter on the fourth candle. Same also with those, instead of waiting for the impulse to form, when you have already seen the possibility of an impulse, two candles already in a string, you know that the third candle is most likely to be an impulse, so they exit on that candle, right? Now, but that is when you are trading with fear, emotions, and other doubtful sentiments, right? But now look at this. This candle did not close as an engulfing candle. Is that not so? Second candle, still within the other candle, there is no uh, show of strength to engulf this candle. So two candles within this previous candle means that, well, you have to wait for that impulse to form. So no need to be in a hurry and use fear to exit this market. So you are still on your sell. That is what it means. You are still on your sell. And then if you did not enter on a previous sell before, let's look at it. If this market comes down or goes close to your sell price, where are the sell prices here? There are three sell prices here. Let's look at it. You can take your sell again. So in this case, we are most likely going to take a sell again, not minding what this market is doing here. And then for most people, that might seem to be going against what the market is doing at the immediate time. But we are not going to rush it. We have two places we can enter again because we can repeat our entry. The most important place here, the most important place here is you see this entry price here, that is 1.2283. That is the most important place for entry. Now, still using the same stop loss here. Okay, so but if you were too skeptical because you don't want to enter when the market is changing, you want to say, okay, let me go closer to the stop loss to reduce my risk. Okay, or use the fourth candle principle that, okay, what if I enter on the fourth candle, then the next entry price would have been 1.22870 because you are not in the market. But if you're in the market, you don't need to be doing all of this or that. So we have to enter again, we are following our rules. So if you are not going by this, then the last place to enter is here on a sell, because this is a sell market ongoing. And today is Thursday. So for the whole of this week, the market has been doing a correction and the correction is not complete. There is still enough room on the downside up to 1.218. 1.218. So you can see if you take any entry from around here, that will give you over 100 pips if you wanted to hold to the end of correction 1.228. If you wanted to hold until all of correction to the end of correction, because of course by Friday this market should have completed this journey. Okay, so you would have taken your market at 1.228 and hold it to 1.218. That's 100 pips. 100 pips is possible here. So if you miss this entry because say the market did not come to your first ideal entry price or the second ideal entry price or the third ideal entry price, where next can you enter? You see the market is forming an impulse, so which means that just like it formed an impulse here, you are going to enter again when this new impulse forming, if it closes as an impulse, breaks. Okay, so when this new impulse breaks, you follow this impulse, same entry rule that's applied here, you do it here. Now notice again that this is a bearish formation. If you are following market structure, you'll notice that this was where your previous impulse broke, right? So where was the previous one? Where the previous impulse broke for the okay, so you can use this to show the structure that is coming down. One here. Okay. All right, so this is enough for us right now. Then, or start of impulse, not just necessarily where it broke, start of impulse too. So, so we have looked at all of that. Let's now wait for either of our new entry prices. So first, we are waiting for this impulse to close. You are waiting for this impulse to close or get terminated, or for it to come to our entry price. So we're not placing any pending order here, which means that we must see the outcome before we take an entry. So until then, we'll say bye for now. We'll be back to continue our analysis. Thank you.